This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
We can talk about causation, especially causation with hindsight, all we want. Without it, there'd be no cable TV investment shows. But the unsatisfying reality is sometimes stocks just go down. And they go down no matter what. Sentiment turns pessimistic, and seemingly good news, and of course bad news, gets spun negatively. Folks, we've been in these periods before, many times in fact, usually once or twice a year, on average, going back 100 years. And here we go again. So up next, there's always uncertainty, but we get it. There's probably more uncertainty this time around than usual. Let's take stock. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here. It has been a very challenging few weeks in the markets. The S&P off roughly 10% from the July highs. NASDAQ almost 13%. And importantly, the bond market off almost 5%. So it's just been very challenging, with the only place really providing any kind of refuge is cash. This time around, of course, in addition to the dysfunction on Capitol Hill and the horrific news flow coming out of Israel, the market is really tough to figure out. It seems simultaneously, maybe paradoxically, concerned with the inevitability of an economic slowdown and data indicating the economy's resilient, and thus egging on a hawkish Fed. So there's a lot of sort of chicken and egg stuff going on here, right? Because the more hawkish the Fed is, the more the scales will tip in favor of a possible recession. And of course, add in the fact that earnings so far this earnings reporting season have not been that great, a little disappointing, if I'm being honest. And the penalty for missing earnings has been greater than we've seen in several years, while the reward for beating earnings has actually been less statistically than we've seen in several years. That's according to FactSet. And of course, we're starting to see some cracks in the previously unassailable mega-cap tech stocks. Like I said, NASDAQ off almost 13% since the July highs. Very rough week for some of the biggest names. So the mood's as sour as it's been in a long time. But remember, the markets are discounting mechanisms, right? And as painful as it is to watch them struggle in real time to sort of recalibrate from that consensus soft landing narrative that was kind of carried the markets over the summer to what is now maybe adding in some more potential risk to that narrative, we will find some footing. My colleague Chase Hinderstein spoke last week about the black swans, right? Well, very important show, I think. But the current news flow, in my opinion, will not be enough to fuel a major market downturn, in my opinion. So hang in there. But the key point I really wanted to make is not to offer market commentary. It's to say that when markets get more volatile, it doesn't mean you need to get more volatile. I think there's a human I know there's a human tendency when things get more hairy to think you have to take some action, that you have to do something. You have to assert some control in what is sort of an uncontrollable world. And what does that mean? It usually entails what? Doing a lot more trading, maybe doing some selling things that are going down and moving into assets where you think you're going to be safer. Listen, I have no problem with selling, rational, intelligent selling. Maybe there's a decline in the fundamentals that warrants a sell. Or from a portfolio perspective, maybe you need to raise some cash for a planned acquisition or planned expenditure. Or you're a retiree, you're living off the portfolio, you want to have more of a cash buffer. I don't have a problem with any of that. But selling out of nervousness to make you feel better never seems to work, in my opinion. Remember that Dalbar, D-A-L-B-A-R, Dalbar Consulting Group study I always refer to, that essentially quantifies the performance of a basket of representative mutual funds versus the returns actually experienced in those funds. Just looked at some recent data from JP Morgan. They looked at the 20-year annualized returns by asset class from 2002 through 2021. So that doesn't even take into account last year and this year, pretty volatile years. Well, the S&P's averaged about 9.5% over that time frame. Guess what the average investor has averaged, according to this study? 3.6, almost a third what the index has averaged. Why is that? I think it's because people overtrade and they hop in and out. They make emotional decisions. I'll leave it at that. Now, of course, this recent stretch has been particularly painful, and this is something we've talked about a lot recently because in many cases, it's the more conservative investors, a lot of our listeners, who've been punished the most. The worst performing assets for the most part this year have been bonds. We've talked about that at length, and I'll mention that again in a few minutes. And a lot of the blue chip dividend-paying stocks. In fact, the performance gap from or between dividend-paying stocks being lousy and non-dividend paying stocks holding up okay is the widest ever recorded in 100 years, according to FactSet. So, of course, bonds and dividend-paying stocks are the bedrocks of most of our portfolios, right? I mean, most sound investors are bedrock that way, particularly if you're income-oriented. So I know it's been tough. This is not a permanent state of affairs. It could easily reverse. It looked a lot different just this time last year. Remember, last year it was growth stocks getting killed. A lot of the dividend-paying stocks were actually the best performers. So things can easily cycle back the other way. But that is the current lay of the land. So I want to talk a little bit more about all this. Actually, just one quick side note. You know, what's another thing that I've always mentioned, and I've mentioned this for years, that the economy is not the stock market, and the stock market's not the economy. To wit, according to Sam Rowe, he's a financial blogger I've referenced a lot on this show, just since the Fed revised their recession odds downwards, okay, in their most recent commentary, stock markets lost almost $4 trillion in stock market value and market cap. Think about that for a second. They have essentially improved their economic outlook, and the market's lost $4 trillion since then. Okay, again, the economy is not the market. Market is not the economy. But again, just to dig into sort of the character of the market for a few minutes, because I think it's important as we get our September statements, October statements, that we kind of understand what we're all looking at. You're probably seeing a lot of red. You are probably seeing a lot of red in your portfolio, even if you're still positive for the year. And why do I say that? Well, I looked at the Russell 3000 index in preparation for this podcast. The Russell 3000, it's a broad index, obviously, of 3,000 names. That's a pretty reliable benchmark, or at least a representative benchmark of the overall U.S. stock market. So not just large stocks, some small, some medium-sized companies. Well, get this. This is as of Monday, so it doesn't even take into account some of the selling that we saw later in the week. 60% of the constituents in the Russell 3000, again, according to FactSet, 60% were down on the year, almost two-thirds. And the median stock down almost 8%. Think about that. 46% of the index, almost half of the Russell 3000, down 10% or more. 39% down 15% or more. Almost exactly a third down 20% or more. And this is before some of the selling that we've seen towards the end of the week. Okay, so if you're looking at a portfolio with 20, 30, 40, 50 holdings, or a mutual fund, and you're analyzing the holdings of the fund, you're going to probably see more in the red this year than not, even if you're a pretty good investor. And I say that because 8 out of the 12 sectors in the S&P are negative for the year. Consumer staples, energy, financials, healthcare, materials, real estate, utilities, industrials, all negative for the year. The reason I bring all this up is because, again, if you're looking at your portfolio and you have a number of quote-unquote losers, at least losers from January 1st, doesn't make you a bad investor, doesn't mean you should be dumping stocks. You know, go back 2 minutes to where I talked about overtrading. The tendency is to fire some of the losers and buy some of the winners. That may be the absolute wrong call at this point. I say maybe because I don't know, okay? But it would not surprise me if we're talking again in 6 months. Maybe economic conditions are different. Who knows? Maybe the Fed's cutting rates. Maybe the economic data is a lot softer. Leadership could be completely different, just as it was this time last year. So I would focus less on kind of what's up and what's down, and more on the actual fundamentals of what you own, the thesis behind your investments. Make sure you understand what you own, okay? And by the way, and I've talked about this for a while, that virtually all the performance in the market this year has come from 7 stocks. They even have a little name, the Magnificent Seven. These mega cap tech stocks that have done well. Well, even there, it's even within technology, it's a very narrow market. In other words, if you look at the NASDAQ as a whole, for about 7 or 8 months now, according to FactSet data, the number of new lows has exceeded the number of new highs. So it's not that all tech is doing well, it's just a handful of techs. And you might be wondering, how does sort of growth look versus value? Well, that's not even close. I mean, as of Monday, according to FactSet, the Russell 1000 Growth Index has outpaced the Russell 1000 Value Index by almost 28 percentage points. 28. That's the third biggest spread, I think, or I should say the third biggest outperformance of growth over value ever recorded, or at least going back to when these indices were incepted. Now, I know it's a little bit unfair, right? Because a lot of the value indexes are packed with financials, and banks have had a very tough year. And of course, the growth index has a lot of tech. But still, if you're a dyed-in-the-wool value investor, it has been challenging. But again, the point I'm trying to make is get very careful about overreacting to these current trends. A lot of it's driven by interest rates going up, nuances in the economy that could look a lot different in 2024 or 2025. Just think about that. Relatedly, I mentioned how conservative investors have had a tough year. Bonds continue to have a very tough go of it. I've spoken several times, and I said this back in January, that bonds in the United States have never been down, at least if you look at the representative kind of broad benchmarks. Bonds have never been down 3 years in a row. Well, here we are, mid to late October, and the Barclays Aggregate Credit Index, which is sort of the index that most people follow, it's down almost 4% for the year, okay? And, of course, this follows on what has really been the worst bond bear market in history. I was reading a piece from the guys up at Ritzold Asset Management, and they looked at some previous bear markets, and they essentially found that this was the deepest and longest bear market for bonds ever recorded. The only exception, get this, is from 1835 to 1839. Okay? Bonds were down for the bond bear market lasted about 56 months back then. And that's because President Andrew Jackson made it his goal to pay off the national debt in the U.S. in its entirety. U.S. economy cratered like 33%. Bonds had a tough time. But even then, the peak to trough performance, according to Ritzold, was only minus 16%. So far, through the end of October, we're down almost 25% with a duration of 28 months. Again, I don't want to belabor this point, because if you own bonds or you own bond funds, you already know this. You don't need salt in the wounds. However, and I've been saying this consistently, I have no idea on the timing. It can get worse before it gets better. I mean, the 10-year Treasury is just shy of 5%. Wouldn't surprise me if it went to 5.25 or 5.5. But I strongly believe that we're in the later innings of this, okay? And, in fact, some pretty prominent investors, like Bill Gross. Remember Bill Gross? He was the bond guru in this country for a long time, ran the PIMCO Total Return Fund. Bill Gross, he's no longer with them, but Bill Gross came out the other day and said that higher for longer was yesterday's mantra, and that the economic data is slowing faster than a lot of people believe. He thinks rates will come down. I have no idea if he's right, but we're starting to get some whiffs on that. But the reason I bring this up for a couple reasons, not because I'm in the interest rate prediction business. I honestly don't know where rates are going to be, and no one else does either. But you should know two things. One, there is a very strong statistical correlation. I mean, literally almost a 97% correlation, according to Bloomberg and others, between starting yields in bonds and future 7-year returns. So if you're getting, let's just, for argument's sake, say you're getting between 5 and 6% on bonds today, whether that's corporates, treasuries, whatever it is. There's a pretty good chance, a 97% chance, that that's going to be pretty close to what your returns will be from fixed income over the next 7 years. Not making price predictions, not making performance predictions, but that's what history suggests. So that's one thing. So today's headwind could be tomorrow's tailwind. I just don't know when tomorrow begins. But the other thing is the way the math works, there is not a one-for-one relationship between the pain that you feel when rates are going up and the relief you feel when rates are going down. Again, this is if you're a fixed income investor. Read a really good piece from JP Morgan on this. I want to give them credit. But essentially what they said is, if you assume a parallel 1% move in interest rates higher or lower from current rates, this is how different sectors across fixed income would perform. So, for example, if you look at 2-year treasuries, a 1% rise in rates would lead to a 3.2% loss. 1% drop in 2-year in rates would lead to a 6.9% gain. Go out 10 years. Think about this. 10-year treasury. 1% rise in rates should lead to a loss of 3.4% from a mathematical perspective. But a 1% drop in rates could lead to as much as a 12.6% gain in 10-year treasury prices. And I could go on. They reference other asset classes within fixed income. And again, they're not in the price prediction or the market prediction business either. They're looking at this as purely a math exercise and the way the math works with bonds. You know, the reality could be different, right? Because it's subject to investor emotions and buying and selling and what have you. But just, I think the point is here, don't get too caught up in the specific numbers. I think the point is that the risk reward starts to tip in your favor given where rates are today, meaning the gains from a drop in rates could outpace the losses in any further rate increases. So that's why I say that if you're sitting there thinking about adding some duration to your portfolio, maybe moving some of your cash, not a bad thing for you to consider that if you can tolerate, being wrong for a while. Okay, so again, you have to examine your own particular situation, see if it's right for your portfolio. I can't give any blanket advice through the podcast, but something for you to think about. Last thing I just wanted to touch on from kind of a macro perspective, I do want to leave some time to comment on a few of the earnings reports because, of course, we're right in the middle of third quarter earnings reporting season. But, just a few things you may not know or maybe you do know, but you don't necessarily appreciate about the economy because the negative headlines have proliferated so much. And I'm not being Pollyannish about risk. I'm very well aware of the fact that the, Conference Board's leading economic index has declined for 18 straight months, and that's historically been a really good, reliable indicator of recession. So it's still very possible we get a recession in 2024, even though I know the Fed and others have reduced the risk of recession. So again, we're respecting that risk. But some things that you may not know. According to the Survey of Consumer Finances, which is a Fed study, Americans' net worth surged by 37% from 2019 through the end of 2022. 37%. And that's adjusted for inflation. That's beyond inflation. That is the highest on record. And quite frankly, if you go back to, I guess 1980, 81, it's not even close. There's never been a 2-year period like this in U.S. history where household net worth has improved that rapidly, and that's significantly. And by the way, certainly higher housing prices played a role in this, but digging into the data, what's interesting is renters actually had a bigger increase in net worth. So it's not just housing prices. There are other factors going on. And just a couple other things, if you look at the economy, I think people underestimate the impact of net worth in people's decision making. And the fact that housing has done so well in particular, it's a source of fuel. Okay, so we're all been reading about how a lot of the stimulus money has rolled off, and that people have spent their pent up savings. People didn't spend money during COVID. Now they have, and now it's exhausted. We've all read this stuff, right? But the reality is net worth has increased so much, and not just for rich people. In fact, yes, the top 10% of America has made up almost 70% of the gains in net worth. But on a relative basis, the bottom 50% of the country has seen by far the biggest growth in net worth. Again, this is according to that same survey. So this is not just a rich people phenomenon. And the other thing that speaks to kind of the broadening out of this improvement in household balance sheets is that for the first time in several years, wages are growing faster than inflation. In fact, it's been that case, I think this is the 6th month in a row, that wage growth has outpaced inflation growth. So yes, inflation is still higher than it should be, than we'd like it to be is probably a better way to put it. But the reality is wages are not just keeping pace, the gap is actually widening. Last thing I just wanted to say that kind of on a positive note that you may not know, I think inflation's pretty misunderstood. I mean, I actually read a study, again, I think it may have been from Ritz-Old Asset Management, but something to the extent that something like 60% of the people that were polled still think inflation's about 9%. The reality is inflation's come down 12 out of 13 months, and people can choose to not believe the government figures. I get that. But basically, everything has been declining in that consumer price index, with the exception of fuel prices and to a lesser extent housing prices. I'm going to talk about that in a second. So in particular, the food category, it's the lowest food inflation we've seen since June of 21. Food inflation in the most recent reading dropped to 2.4%. It was 13.5% at one point last year. Used car prices, which are a big reason why inflation went up last year, at their lowest level since March of 21, down 18% from their peak. But the other thing I just wanted to mention briefly is shelter, which takes into account housing and rental prices. Shelter is about a third of the consumer price index. And I mention this because it works with a significant lag factor. In fact, in some ways, the housing inflation data is still picking up readings from the peak of the housing market last year. Okay, so the fact that housing prices have come in a bit and rents have dropped a fair amount has not been recorded. And if you do the math, it's pretty clear that if you backed housing out of the CPI figure, inflation would be somewhere in that 2 to 2.5% range, which is basically the Fed target. I think as housing continues to roll off, yes, you'll get some volatility around gas prices, but I think inflation has a really good chance of settling back under 3%. Whether it goes to 2, I don't know, but I think it'll come down significantly, hopefully to a level where the Fed feels that their work is done. Again, I don't want to spend too much time on the macro economy. I started out the show by saying the market isn't the economy and the economy isn't the market, but I do think a lot of the economic outlook is misunderstood. Yes, there are plenty of negatives, plenty of things that we're watching, and the reality of a possible recession is still very much there. But there's some positives, some underlying positives that makes me believe this is not 2008. The consumer is coming into 2024 in a much better, much less leveraged position than he or she was 13, 14 years ago. So I think even if we do get that type of downturn, I don't think it's going to be severe. Okay, let's leave the macro and let's shift to the micro. Obviously, this was a very big week for corporate earnings. I said at the top that unfortunately, earnings misses are being punished more than usual, and earnings beats are being rewarded less than usual. So it's been certainly a tough week for stocks, but I do want to comment on a few that stood out for me. I know Chase is doing the show next week. He'll have some others, but stick with me. Back in a minute. We'll cover the latest. Don't be forced to sell stocks in a bear market. Now is the time to review your financial plan and determine how much liquidity you truly need. I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know. To learn more about how to manage your cash flow and to become a better informed, wise investor, listen to the Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
So as promised, I would like to bring you up to speed on what we're hearing from some of our top holdings. We're getting the third quarter earnings reports. And as I always say, it's important you do your own homework, okay? So when we talk about an individual stock, it's something that we've vetted, we've researched, we feel it's right for and suitable for the clients that we manage in a representative share size. But I can't manage your portfolio through the computer. So if you're not a client, you really need to do your own homework, weigh the pros and cons, the pluses and minuses, see if it's right for your situation. And all the stocks that I'm going to talk about this afternoon are ones that I own in my personal portfolio. So you need to evaluate whether you think there's any conflict of interest that I might have in talking about a particular name. So with those disclaimers behind us, let's talk about a few. So Alphabet, formerly known as Google, symbol GOOGL, had a terrible Wednesday. They came out with their earnings and dropped, I think, about 10% or so in Wednesday's trading. By the way, given how large Google is, the drop in their shares just in one trading day was equivalent to the entire market capitalization of Nike. Think about that for a second, okay? So what happened? Well, keep in mind, Google had a strong year up until this print. I think they were up over 40% coming into the print. And what the market really seemed to key on here was the fact that their cloud growth, their cloud storage product, decelerated. Okay, you saw deceleration in growth there. I think they were supposed to come out with, or they were expected to come out with about 26% growth year over year. They came out with about 22%. And I guess the fear, for lack of a better word, is that a lot of those sales are sort of artificial intelligence, AI-related sales, and that Google is seeing deceleration there, which really lends credence to the idea that a big part of the upward thrust in a lot of these big tech companies this year had to do with artificial intelligence. That was the narrative carrying a lot of these companies, and any sign of deceleration there, either as a group or on an individual basis, is going to get punished. So that's kind of what happened with Google. But I think on a positive note, I think there's several positive notes for you to think about. I think this kind of monolithic analysis, if you will, limited analysis of Google really misses a lot of the very strong positives coming out of the quarter, namely YouTube, which just a few years ago, they had barely monetized at all. Okay, I mean, YouTube was a money loser for them. YouTube numbers were very strong. And what we've really seen is some pretty positive signs that we may be emerging from a 3 or 4 quarter advertising slump. You saw advertising really turn a corner. On the bottom line, we saw some really good margin numbers, expense discipline from Google, and the fact that they were able to deliver almost $80 billion in free cash flow over the past 12 months during what is considered a trough period for advertising spend, which is the main source of their revenues by far, is pretty encouraging for the future. Okay, so and then Google on a valuations basis actually looks pretty darn interesting. Okay, and I mean if you look at them on a price to earnings basis, well, let's put it this way: if you look at them on a price to cash flow basis, they're trading roughly 19 times earnings. If you look at the consensus multiple according to FactSet, if you look at FactSet's numbers for 24 or estimates for 24, trading about 17 times that number. That stacks up pretty favorably with other tech companies, and this is for a company that, according to FactSet estimates, should be able to average low teens earnings per share growth on average over the next 5 years. So you're basically paying at most maybe a market multiple or a slight premium to the S&P for what FactSet believes will be superior execution. So there's certainly risk to the story. I mean, if investors continue to exclusively focus on AI and they see Google maybe losing a little bit of market share to others, maybe that limits the stock for a while. But I think on the positive side, there's enough free cash flow growth and visible growth into their other business lines, and quite frankly, more important business lines at this point, that Google is going to start to screen in a more interesting way. So again, there's certainly risk to the story, not to mention if people decide to sort of fade out of large cap tech for a while, which certainly happened last year, if you recall. Large cap tech was the worst place to have your money for most of 2022. But if you're a patient, long-term investor, Google may be, I don't want to say it's the value play among mega cap tech, but that may be one way to think about it. On the other side, by the way, Microsoft impressed investors with their numbers. In fact, they had sort of the opposite story. Their Azure, A-Z-U-R-E, Azure cloud storage division actually grew faster than estimates, which led people to believe that maybe they're picking up market share in artificial intelligence related solutions. And Microsoft was awarded some. And, we own Microsoft in our portfolios as well. I own it personally. I think the difference between Microsoft and Google is the valuation. Microsoft is trading over 30 times earnings and trading at a pretty close to a premium to where they've been over the last few years, not a discount. So we might argue that Microsoft deserves that premium because their execution has been so good in AI, but it also means their margin for error is less. So, if you want exposure to that landscape, that narrative, whatever word you want to use, that artificial intelligence narrative, some sort of combination of Microsoft and Alphabet probably makes some sense to consider. Again, see if it's right for your portfolio, if you want to be in that space, if you can tolerate some of the volatility in these names. Just one other positive I'll mention to you. Both Alphabet and Microsoft have positive net interest margins, meaning they're earning more on their cash through higher interest rates than they're paying out in interest on some of the low yields they have on their debt. Okay, so here we're talking about the stress of higher interest rates. Both Alphabet and Microsoft are actually benefiting from that at this point, believe it or not. That's an important point of distinction versus some more leveraged companies. Speaking of leveraged companies, I think the markets were positively surprised by the telecommunications companies. Both AT&T and Verizon beat estimates on the top line and the bottom line. Both of these companies have been much maligned. Okay, for their leveraged balance sheets, a lot of competition in that business that's really hurt margins. Not to mention their dividends, which are high, are less attractive relative to treasuries, certainly than they were a couple years ago. So both Verizon and AT&T have been under a lot of pressure. And again, as I was saying earlier in the show, a lot of these high dividend paying sectors have been negative for the year for that reason. People are saying, well, why should I take on the risk of a dividend-paying stock when I can get 5% in the bank with no risk? And I can't fault the logic in the short term. But I think I can fault the logic over the longer haul because I'll just mention AT&T for a second. I think the story is very interesting here. For one, they reported fiber revenue growth of almost 27% year over year, with total broadband revenue growth of about 10%. This is from Raymond James, the Raymond James analyst. That's the best numbers out of that business they've had in several years. I think what's happening here is AT&T's always been a complicated story, right? They decided that they needed media, so they've made some huge acquisitions to pick up media content. They've had some failed acquisitions along the way, like the Dish, remember that whole thing? All of which have cost them billions of dollars, have led to a bloated balance sheet, a very complicated story. And I think what current AT&T management is trying to do is to make it a more streamlined, easier to understand story with a steadier, more consistent pace of capital expenditures. And so not only were those results on the broadband side encouraging, but we also saw much better free cash flow guidance than we've seen from AT&T in a long time. And I think that was very well received. It gives people confidence that they're going to be able to maintain their dividend, which was kind of up for debate. Also, for the first time in several years, their leverage falls below 3 times. They were over 4 times levered at one point. So they've been obviously using some of that free cash flow to pay down debt. It's a cleaner story from that perspective. And it's trading at its lowest valuation that I can ever recall. I mean, I've been following AT&T, since I've gotten in the business, and they're down to roughly, according to FactSet estimates, about 6 times earnings, give or take. I mean, obviously the S&P's up in the high teens. And I'm not saying they should trade at that type of multiple, but I mean, historically, according to FactSet, they've been between 8 and 12 times earnings, not at 5 or 6 times earnings. You could say something similar about Verizon. So there's certainly more risks to the story. As if we do get an outright recession, of course, and consumers are pulling back on their cable packages and their telecommunications spending, I would think that's probably the biggest risk to the AT&T story. But I think the low valuation and the pretty strong evidence that free cash flow has some legs hopefully gives you some protection. So I'm not telling you to rush out and buy AT&T and Verizon today, but considering that their stocks have been sort of neglected and are hardly mentioned anymore in the financial media, maybe there's an opportunity to look at something that's a bit out of favor. Last thing, there are other companies I'll get to either next time I do the podcast or maybe Chase will get to next week. But I did want to talk about Thyself. You may not know the name Thyself because they don't have a branded product, but a number of our clients use Thyself every day. So they manage a lot of the electronic transactions that financial firms and banks use, as well as retailers use. Customer transactions. Here at Raymond James, when we do an ACH, when we do a direct deposit out of an account to somebody's bank, that's a Thyself transaction. Okay. What attracted us to Thyself initially was their consistency. They literally have something like 35 or 40 years consecutively of double-digit earnings growth. I'm not exaggerating. Okay, there's been that type of consistency. So that nuts and bolts financial transaction business, bank and financial services firm business is sort of that conservative anchor part of their business. What's been more volatile have been some of their software solutions on the merchant side, basically software designed to help merchants process financial transactions faster, receive payments faster, make payments faster. And there's a lot of competition in that business, a lot of new entrants into that business, a lot of what they call disruptors in that business. But the most recent quarter shows that Thyself seems to be doing the right thing. Their main software product in that area, Clover, growth accelerated from 15% in the second quarter to 26% year over year in the third quarter. So not only is it being adopted apparently by more customers, it looks like they're actually picking up market share. As a result, Thyself was not only able to raise operating margin guidance, but also earnings guidance, and importantly, free cash flow guidance, significant guidance. In fact, they raised their free cash flow outlook up to $4 billion, which was a 5% increase from the previous outlook, according to the Raymond James analyst. Okay. However, with that, Thyself still trades at a 20% discount to the S&P 500. Raymond James notes that over the last 5 years, they've averaged an in-line valuation, or in line with the S&P. Now they're at a 20% discount, despite, like I said, improving free cash flow, an expectation that earnings growth will be in the low to mid single digits. Again, this is according to Raymond James research. So, if you're looking for a name in that sort of fintech financial space that, yes, sure, there's some risk to the story. I mentioned how there's some new sort of up-and-comer entrants into that business, but this recent set of results, I think, should be encouraging if you're looking for how they're doing versus their competition. Recession risk is always a risk for a company like a Thyself because if you have less transactions in general, that can obviously weigh on their volumes, weigh on their earnings. But the size of the transactions don't impact them as much. Okay, so in an economic slowdown scenario, people are still doing things. They may not just be doing as many expensive things. That usually leads a company like Thyself to be more defensive than a bank. But there is still economic risk, so make sure you understand that. So I'll leave it there. Thyself, AT&T, to a lesser extent, Verizon and Alphabet, I think, are interesting to consider. We own all of those in our portfolios. We also own Microsoft in our portfolios, and I own all of those personally. Again, if you're not a client, do your own homework. Make sure it's right for your particular situation. All right, I'm going to leave it there. I know that was a lot. There is a lot going on in the world, but the first thing I said is probably the most important. Just because the markets are more frenetic, markets are more volatile, does not mean that you need to be more volatile. Keep that in mind. Chase Hinderstein will be with you next week, cover some more of our top holdings who've reported their earnings. I'll be back with you in 2 weeks. As always, until then, stay healthy, and I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.